everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today on the show, on the podcast. So we're talking about paying yourself today as a business owner. So if you are not a business owner, you're still welcome to listen in because you may someday decide to start a business, and this will be important. But I'm talking to business owners today, the entrepreneurs who are running their own business. And this can be a business of any kind. It can be a small side gig. It can be something you're doing kind of on the side. It can be something you do full time. It can be a larger business. But I primarily work with smaller businesses, maybe a handful of people, often solo business owners, people that are running a solo business, or maybe they have a couple of team members or a small team, but that's typically who I work with when it comes to business owners. So this discussion will apply to that type of situation today, primarily, sole proprietorships, LLCs, maybe an S Corp, and we're going to talk about paying yourself today. So paying yourself. Let's talk about, first of all, the mindset of business versus hobby and how paying yourself fits into this and is very important. So I often see a lot of business owners that are, they say they're running a business, they think they're running a business, but in reality, it is not operating quite as a business. It's more of just kind of a side interest or a hobby. And a lot of it comes down to how much of a commitment you have toward paying yourself. That's often what it comes down to between a business and a hobby. If it's a hobby, you're not really making money. You're not really paying yourself. You're doing it for fun. And if you enjoy doing what you're doing and you want to make it a hobby, then by all means, that's fine. But if your goal is to run a business and your goal is for it to grow and generate income for you and become something that sustains you and builds wealth for you, then you want to run it as a business. And there's tons of conversations we could have around different details of running a business and what makes it a business. And that's for another time. What I'm going to focus on today is the aspect of paying yourself. So let's talk about some logistics of paying yourself, what it looks like, how to do it, kind of a mindset around it. So first of all, let's talk about the logistics of banking. So I know some business owners I talk to don't have a business bank account. They run everything through a personal account. Whatever money they are making in their business, it goes straight to their personal account, and it all kind of gets lumped together. So right off the bat, that can get messy. That is not ideal, in my opinion, when running a business. You want to have a separate business bank account, and you want to have a structured way to pay yourself. So some business owners, they do have a business bank account, but they don't really treat it like a separate account. They treat it, it's what I call piggy bank syndrome. They treat it like a piggy bank. They basically, they make sales, revenue comes into their business bank account from business activities or services, and then they just kind of leave it there. And then they just kind of pull it out when they need to. It's kind of like, hey, this piggy bank is sitting over here. I'm just going to kind of pull money out when I want to. And there's no structure or no intention behind it. It's just kind of a pile of money they just kind of grab when they need it. And that's why I call it piggy bank syndrome. There's no consistency. There's no plan for it. It's just kind of treating it like a piggy bank. We want to avoid that. Ideally, you want to have a separate business bank account, and you want to have an EIN for your business, which is an employer identification number. It's your tax ID for your business. And that is the structure that is typically ideal for most business owners. Separate business bank account, EIN for your business, which is their tax ID for a business, and you keep that separated. That initially, right off the bat, gives you a clean separation with your finances. You want to have a clean separation in business money coming in and business money going out. And over here on the other side, you've got personal money coming in and out. And those two should be very separate. The only time you should really kind of cross over is when you're paying yourself, which we will talk about. So again, keep that in mind. The first thing we want to do is to make sure your business account is separate from your personal account in a separate business bank account. So next, let's talk about how to pay yourself based on your entity type. So there's kind of two main entity types I'm going to talk about today. One is the sole proprietorship / LLC, and the other is the S Corp. So a lot of us, I'd say more often than not, the business owners I work with are LLCs or sole proprietorships. They are very similar, except for an LLC is a registered entity that is a separate entity that is designed to give you some liability protection, hence the name limited liability company. So that allows you to have a separation from a legal standpoint, in which if there is some sort of liability event in your business, in theory, it protects your personal assets because the liability kind of ends with your business. Now, there's lots of details that go into that and how you run the business, how you behave in the business, that can affect that. But in general, that's conceptually what it's for. A sole proprietorship is similar, except there's no liability protection. It's basically just you're kind of operating as you. And if something goes wrong in your business, then in theory, someone could come after your house or assets. So, but from a pay standpoint, they're very similar in how you want to pay yourself. So in the sole proprietorship slash LLC model, you pay yourself by moving money from your business account into your personal account. Very simple. These are called distributions, also sometimes called owner's draw. So owner's draw or distributions is how you pay yourself. And you're moving your money from your business account over to your personal account. So that is literally just how you're giving yourself a paycheck. You're moving that money over. So for that reason, I say this over and over to people. People don't really think about this too much, and they kind of get hung up on, well, my bank is local and I like it, or I'm going to stick with my bank or whatever. It's really important, I think, to have a bank that offers free ACH payments, because if you have to write a check to yourself, that's annoying, or if you have to pay a fee to do electronic payments, that's irritating. So you want to have a bank that makes it really easy to go online, click a button, move money, and pay yourself through electronic payments, which is called ACH. So if you need a recommendation, email me, let me know. I'm happy to make a recommendation for banks that offer free ACH and can make that super easy. So you don't want any friction when it comes to paying yourself. So again, with an LLC or a sole proprietorship, it's called a distribution or an owner's draw, and you're simply moving that money from your business account to your personal account. That is the only time you should really cross over between those two accounts, is when you're paying yourself. Let's say you're an S corp. S corps are a little bit different. They are structured a little bit differently. And with an S corp, you need to run your payroll through payroll. Your compensation, I should say, would go through payroll. So you've got to use a payroll system. I guess you don't have to, but in theory, it's much better and easier to use a payroll system. So you've got to, use a payroll system, and you pay yourself through payroll and sometimes distributions or owner's draw. So with an S corp, you are required to give yourself a reasonable salary. What's reasonable is open for interpretation. The IRS just says reasonable. So in general, what you want to think about is when you're paying yourself through an S corp payroll, what would you pay someone if you were to fire yourself and replace yourself with someone equivalent? So a lot of times I see S corp owners, they try to kind of skirt the system, and they try to pay themselves a very low salary and then give the rest through distributions, because that does avoid payroll taxes. But that's really not ideal, in my opinion. You're kind of putting a target on your back. The IRS doesn't want to see that. Opens you up to some liability, potential audits. So when you're paying yourself through an S corp, my advice is pay yourself a reasonable salary based on what you would pay someone else in your position. So in that case, the payroll kind of takes care of itself. You're going to run payroll ideally consistently and run that through a payroll system. And if you have any additional money, maybe at the end of the year or each quarter, if you've got some extra profits, you can pay yourself those distributions by transferring money from your business account to your personal account after you've accounted for your regular payroll. That is how you pay yourself in an S corp. So let's talk about when to pay yourself. So first, you want to include your income as an outflow in your business's cash flow. And I've got a spreadsheet I'm going to share with you at the end of this episode, which I think will help kind of visualize this a bit better. But you want to include your pay and your compensation as an outflow. You want to prioritize your pay. You want to make it consistent. You want to avoid this piggy bank syndrome of just grabbing money when you need to. So ideally, you want to have a set schedule. Maybe it's every month. Maybe it's every 2 weeks or every week or whatever you want it to be. Personally, I like every month. It's just kind of very nice and clean and simple. So let's say it's every month. Well, every month you've got expenses in your business, right? You've got, software to pay for. Maybe you're paying for an office rent. Maybe you're paying for professional services, insurance, things like that. These are all things that are likely coming out of your business bank account every month as an expense. One of those expenses, and in fact, the number one expense, should be your compensation. So at the top of the list, your compensation should be listed as an expense. So let's say you're paying yourself, I don't know, $3,000 a month or whatever it's going to be, or 4,000 or something. That should be the number one line item in your expense category. Everything else should be listed after. And we'll talk about that a little more in a minute when I look at the spreadsheet with you and kind of open it up and describe it. But in theory, that's what you want to do. The short answer for the reason for that is that by prioritizing your own compensation, you are setting a precedent that your business is designed to make money for you. And that mindset seems very obvious and very simple, but so many business owners just ignore that mindset. They just run a business by, revenue coming in, expenses going out. They don't really pay themselves. They grab money when they see it's there. There's no rhyme or reason to it. And you can't really plan personal finances based on that inconsistency and that lack of intention as well. So, we'll talk a little bit more about that, as I mentioned, but your pay for yourself should be a line item. If it's an S corp, it's really easy. Payroll is an expense. That's easy. Well, I should say easier. But a lot of business owners are LLCs. It's a very typical model. LLCs are very common. And when you're an LLC, you don't have to you don't run through payroll. You're not supposed to, and you're just paying yourself by moving that money over. And it's very open to whatever you want to do. It's very kind of free form. And so it's really easy to say, well, I've got to pay my insurance and my rent and my software fees and all this stuff and never get around to paying yourself. So let's talk about the advantages of strong, consistent pay. For one thing, you get a mental boost from getting paid what you're worth, and that's valuable. So you just carry yourself differently when you're paying yourself, or at least paying yourself, hopefully appropriately, but paying yourself something. So again, I keep saying this. I talk to a lot of business owners. I work with a lot of solo and small business owners who they're not paying themselves consistently. They're not paying themselves much. They're just kind of getting by. And they don't think of their business as a wealth building tool. They don't think of it as honestly something that's going to serve them. They think that they're serving the business. They're just kind of wrapped up in it, and their life is owned by the business. And that mindset is easy to get stuck in. It's easy to cause friction and just kind of bog you down in progress, or lack of progress, I should say. So when you pay yourself consistently and you make it a priority, you just start to think differently. You're in sales meetings and you carry yourself more confidently. You feel that you're worth more. You understand that you're worth more. You talk to people differently. You operate the business differently. You're just so much more effective from a mental and a psychological standpoint. So I think there's a lot of value in the mental boost and the confidence that comes from paying yourself what you're worth, or at least what you can consistently. Next, it forces you to plan your cash flow and really pay attention to your business health. If you're making your pay a priority and making it consistent, you're kind of forced to be able to afford that pay. If you're paying someone else, let's say you've got an employee and take yourself out of the picture and you're going to pay someone else to replace you, you would have to be consistent. You wouldn't miss payroll. You would have to make that work. So when you're paying yourself just as much of a priority, then you're kind of forced to really pay close attention to your cash flow and make sure, hey, is that expense necessary? Can I cut this? Can I cut that? Do I need to make more money? Do I need to raise my prices? Do I need to work harder at this? That really kind of forces you to pay attention more and increases the health of your business overall in general, for the most part. It also structures your business as a true business, not a hobby. If you're paying yourself and you're generating income and getting compensated, it's a real business. It's something that's generating income for you. It's not just a hobby. Again, you're going to take it more seriously. It also is a step toward helping your business become more sellable and scalable, which are often one and the same. Now, I realize you may never want to sell your business, or you may not think you're going to today. That's fine. But scaling your business makes it healthier. It helps you make more money. So they're kind of interchangeable. If you're making your business more sellable, it's going to be healthier and more scalable. If you're making it more scalable, it's going to be more sellable if you want to. So by paying yourself and setting that precedent, you are setting up the right systems and the right intention to pay yourself and handle your expenses. So if you do want to replace yourself someday, you can do that. You can kind of step back, hire someone else to take over the business, make it more sellable, and have that scalable structure in place. Also strengthens your personal budgeting. So if you are just grabbing money whenever you feel like it or whenever you can, again, going back to piggy bank syndrome, makes it really hard to budget on the personal side. You've got this irregular cash flow, and some irregularity is going to be natural. But if it's just wildly irregular for no good reason, then it's tough to budget and it's tough to really make progress and get traction and get a good view of what your cash flow really is. Also, it helps promote a separation between you and your business that is healthy. So if you're paying yourself consistently and well, then you are creating a healthy separation where your business is an asset. Your business is something that is generating income and return for you, and it's not your whole identity. You're getting a paycheck from your business, and that feels great, and it's really healthy for your mental state. And so it really sets this healthy precedent that you should expect your business to generate income. You should expect your business to generate a return. That's what it's for. It's also for other things, for making the world a better place and serving people, et cetera. But it's also for making money, which helps you do all those things. So you really want to have that precedent set in place where your business should be expected to generate income and generate a return for you. It's an asset designed to generate a return. So, all this said, it's really important to pay yourself consistently, pay yourself what you're worth as soon as possible, pay yourself through the proper system based on your legal entity, whether you're LLC or sole proprietorship or S Corp, and make it a priority. Make it an expense just like anything else and make it the number one priority. So, I've put together a spreadsheet to help out with this. I'm going to put it in the comments here as well in chat. So if you're watching this either live or after the fact on Facebook or YouTube, you'll be able to see the link to the spreadsheet in the chat or the comments down below. If you're listening to this, as most people do on the audio version of the podcast, this is episode 119, and there is a link to the spreadsheet in this episode show notes. So if you go to episode 119 on my website, so elevationfinancial.com, look for episode 119. In the show notes, you'll see a link out to this Google spreadsheet. So it's really simplified. It's kind of a starting point, but it's one that I, personally use a lot for myself and business owners to help them. So it's designed with a few columns and some rows. So the first column is called monthly expenses. And the second column is just where you put the monthly expenses. So the first column is kind of the label for the expense, and then you put the dollar amount next to it. Third column, average monthly revenue. And then fourth column, monthly retained earnings. So if you're looking at this together with me, what you would do is you would put a list of all of your expenses in that first column, first and second columns, really, because the labels on the left, expense numbers on the right. I've put some basic stuff in there as example, stuff that a lot of businesses have, like, for example, QuickBooks Online subscription, Open Phone for a phone system, social media scheduling tools, DocuSign, Calendly, website, just stuff that is common to a lot of businesses as a starting point. So you'll want to add your own stuff in there and remove stuff you don't use. So by doing that, you'll, first of all, by the way, let me back up. To use this spreadsheet, it's in Google Sheets. You can either download it as Excel or copy it to your own Google Drive. I'm a Google Drive user, so I would just copy it to my drive and then edit it. But if you're more of an Excel fan, just download this as an Excel file and you can then edit it on your desktop. That's how I use it. So you would change the expenses to match your own, but you'll notice something at the top. At the top, it says owner's draw, and there's a number there. There's a reason it's at the top. It's the most important. Now, one thing to note as you're changing expenses here, if you are adding new expenses, make sure the formula still works. So I would probably, right click one of the rows in the middle and then say add insert row below and then add your expense there. That way it kind of pushes everything down and keeps that bottom column correctly totaling everything. So just look at that and make sure that's working. So the owner's draw is in that list of expenses. Then in the third column, column C in the spreadsheet, you're going to put average monthly revenue. Now, if your business is pretty consistent, that's easy to do. Just plug in a number. If your business is very irregular and inconsistent, you're going to have to go with an average or maybe a low ballpark, kind of a minimum ballpark. So use your best judgment there. Then the last column is your monthly retained earnings. That's your buffer. That's what's left over after everything else. So your retained earnings kind of stay in the business for other stuff or a buffer or margin or for investing in the business. So in this example, I've got owner's draw is $3,500 a month. I'm just using some simple numbers here. All the expenses are below that. My total expenses come out to $4,305.49. That gets subtracted from average monthly revenue of $5,000, and I've got $695 left over in retained earnings. You'll notice that this kind of flips the script. The script that so many business owners use is, oh, I'm going to pay all my bills first, and then if I have money left over, I'll grab some for myself. That's the mindset so many of us have. This flips the script. It says, hey, number one priority, owner's draw. Boom. Every month I'm paying myself, in this example, this hypothetical example, $3,500. That's number one. That's the first thing to focus on. Then every other expenses after that. Then the formula just tells you how much of a buffer you have. If you're in the negative, you go back to your expenses and you adjust. You maybe cut out some expenses. As a last resort, yes, you can lower your owner's draw, but that would be last resort. So this kind of forces your mind to flip and say, well, instead of grabbing what's left over for myself, I'm going to take what's owed to me first, and then everything left over, I'm going to apply to my expenses. And if there's something that puts me over the top and I can't afford, I might just cut it out because paying myself is more important. So again, the spreadsheet is linked on episode 119. So if you want to grab it there, go ahead and copy it to your own Google Drive if you want to, or just download it as an Excel file. You can do that in the file menu when you're looking at it. And you can kind of play with it yourself and use it to plan out your pay with intention and kind of look at where your numbers are. And every month I would look at this and say, okay, what are my expenses? What's my revenue looking like? Keep it up to date, keep it adjusted, maybe every week, even open it up and use this to plan out and kind of gamify how you're going to pay yourself and prioritize that. I think that'll be helpful. Let me know what you think. Let me know if you want some updates or explanations around that spreadsheet, but I think it's a great starting point to help you out. So pay yourself. You're worth it. With that, thanks for joining me today. As always, you can find me on the web at elevationfinancial.com. If you want to chat, you can send me a note through my website, or you can email me at podcast@elevationfinancial.com. Or you can, if you want to chat more in depth and ask some questions, you can book a money session on my website. It is complimentary. Look for that button on the homepage. You can do it there. As always, thanks for joining me today. Have a great day. I'll see you next time.